Welcome to Invert That. In today's video, we're going to explore one of the most important ideas in investing, risk. But not risk the way Wall Street usually defines it as volatility, beta, or short-term price movement. The purpose of this video is to understand how Warren Buffett and Charlie Munger thought about risk across decades. Permanent capital loss, leverage, incentives, human psychology, business quality, catastrophe risk, and the possibility of ruin.
Yeah, and to really get at the core of this, we aren't just, looking at a few famous quotes floating around the internet. We're really digging into the actual primary sources.
Right. We're pulling from the Berkshire Hathaway annual meeting transcripts from 1994 all the way through 2022, plus Warren Buffett's partnership and shareholder letters from 1956 to 2025.
And we can't forget Charlie Munger's Wesco financial letters, right? The ones from 1996 to 2009. They're incredibly detailed.
Oh, absolutely. So the objective here is to basically extract the mechanical, practical reality of how they actually managed capital through multiple financial crises so that, you listening to this can apply that exact same framework to your own financial decision.
Exactly, because the central premise that you find when you read through all those thousands of pages is that Wall Street and academia have just fundamentally misdiagnosed what risk actually is.
Totally.
In a university finance department, risk is treated as this mathematical variance. It's just a squiggly line on a chart. But for Buffett and Munger, risk isn't a formula.
No, it's an existential threat.
Right. It's the permanent destruction of purchasing power. And that's caused by, human irrationality or misaligned corporate incentives and especially catastrophic financial engineering.
We really need to start with that academic misdiagnosis because it is so deeply ingrained in how most people are taught to invest. Like if you open a textbook on modern portfolio theory, risk is literally defined by volatility.
Yep. The whole concept of beta.
Right, beta. Which, for anyone who doesn't know, it just measures how much a specific stock's price fluctuates relative to the broader market. So if the stock jumps up and down wildly, it has a high beta.
And so academia instantly declares it a high-risk asset.
Exactly. And if the price moves in a slow, smooth line, it has a low beta, and it's considered safe. It's crazy when you really think about it.
Well, Buffett dismantled that entire premise in his 1993 Berkshire Hathaway shareholder letter. I mean, he explicitly calls the academic definition of risk absurd.
Absurd, yeah.
And he doesn't just throw the word around, he proves it by walking through the mechanics of his investment in the Washington Post company. So in 1973, the market value of the entire Washington Post dropped from roughly $175 million down to about $80 million.
Right, and this was during a pretty brutal bear market driven by the OPEC oil embargo and soaring inflation. So the stock price was just plummeting fast.
Exactly. And because of that rapid downward price movement, the beta of the Washington Post stock spiked.
So an academic analyst looking at the data in 1973 would tell you that the stock became substantially more risky at an $80 million valuation than it was at $175 million.
Right.
Simply because the price had recently exhibited, extreme volatility.
Which is just a fundamental conflation of price action and business reality.
Right.
I mean, Buffett pointed out how incredibly backward that logic is. At the time, he evaluated the intrinsic value of the Washington Post's underlying assets.
So like the newspaper, the broadcasting stations, the real estate.
Yeah, all of it. And he calculated they were worth at least $400 million. So if you're offered a wonderful, enduring business worth $400 million, your risk of permanent capital loss is drastically lower when you pay $80 million than when you pay $175 million.
Cause a lower price reduces risk.
Exactly. It increases your margin of error. To argue that a company is riskier at a massive discount just because the chart looks scary is an absurdity that Buffett spent his entire career fighting against.
And Charlie Munger's take on this is it's even more aggressive.
Yeah.
Like during the 1996 Berkshire annual meeting, he was asked about modern corporate finance and modern portfolio theory, and he completely eviscerated it.
Oh, yeah. He called the whole academic establishment twaddle.
Twaddle, such a great word.
He argued that modern portfolio theory assumes markets are perfectly efficient and all investors act rationally, which, are two assumptions that any student of human nature knows are demonstrably false.
Right. We are definitely not rational.
No, not at all. Munger joked that academic finance involves a type of dementia he can't even classify. He pointed out that Wall Street loves beta and complex risk-adjusted return formulas because they're full of little Greek letters that make the people using them feel like physicists.
Yeah, it creates a barrier to entry. It justifies their massive fees. But it adds zero predictive value regarding whether you will actually lose your money.
Exactly. He advised the audience to just totally ignore it.
Okay, I hear that, But I have to interrupt with some skepticism here on behalf of the listener. Because when you or I open a brokerage app and see a sea of red, the heart rate spikes.
Oh, for sure.
It triggers a very real biological panic response. So intellectually, maybe a falling price isn't risk, but biologically, it feels exactly like it. How did Buffett actually suppress that panic?
Well, let's look at it like a physical asset. If the estimated value of your physical house drops by 20% on a real estate website tomorrow, you don't hyperventilate and sell it to the first person who walks by.
Right, because you live in it. You understand its utility. You know the roof doesn't leak.
Yeah, but the caveat to the housing analogy is liquidity. Your house doesn't have a ticker flashing its price every second of the day, and you don't have millions of strangers screaming at you to sell it.
Yeah, that constant liquidity is what breaks people's temperament.
Exactly. To survive that, Buffett relies entirely on the mental framework he learned from Benjamin Graham, specifically Chapter 8 of The Intelligent Investor.
Ah, the Mr. Market concept. He references that constantly throughout his letters.
He really does. Graham tells you to imagine that you own a piece of a business alongside a manic depressive partner named Mr. Market. And every single day, Mr. Market shows up and offers to buy your share or sell you his.
And because he's manic depressive, his prices are completely detached from reality. Like on days he is euphoric, he names a price that is ridiculously high. On days he is terrified, he names a price that is absurdly low.
The critical shift in mindset is realizing that Mr. Market is there to serve you, not to guide you. If you view stocks as fractional ownership in a tangible business just like your house, then Mr. Market's mood swings aren't a threat.
They're an opportunity.
Right. The more manic depressive the market is, the greater the mispricing, and therefore the greater the opportunity. Volatility isn't risk. Volatility is the mechanism that creates mispriced assets.
So if volatility isn't risk, their definition must be strictly tied to, like, time horizons and business fundamentals. I mean, if I'm day trading, a 5% drop is lethal. But if I'm holding a dominant consumer brand for a decade, that same 5% drop is completely irrelevant to my ultimate outcome.
Time horizon is half the equation. We find their true definition clearly stated in the 1994 meeting transcripts. Buffett defines risk simply as the possibility of harm or injury.
And he measures that possibility based entirely on the predictability of the underlying business, right?
Exactly. If you're buying a piece of Coca-Cola with a 10-year time horizon, the probability that people will suddenly stop drinking flavored water in 200 countries is effectively zero.
Yeah, not going to happen.
Therefore, if the purchase price is rational, the risk of permanent capital loss is nil.
Which means if we discard the academic formulas, we need a completely different tool to navigate the market safely. Because you can't just buy a great business at any price and assume you're safe.
The ultimate tool, the absolute foundation of their entire philosophy, is the margin of safety. During the 1995 Berkshire annual meeting, Buffett explains this using an engineering analogy.
Oh, the bridge analogy.
Yeah. He says you don't try to drive a 9,800-pound truck over a bridge that has a stated capacity of exactly 10,000 pounds. You go down the road and find a bridge with a capacity of 15,000 pounds.
Because the stated capacity might be wrong. The engineers might have made a slight calculation error, or the materials might have degraded over time, or, your truck might be carrying a slightly heavier load than you estimated.
Exactly. You need a massive buffer to absorb the unknown.
But how do they actually quantify that 15,000-pound bridge capacity when they're looking at a living, breathing corporation? Like it's not made of steel.
It all comes down to their calculation of intrinsic value. Based on the 1994 transcripts, Buffett insists that the economic value of any asset is simply the present value of all the future streams of cash going in or out of the business between now and Judgment Day.
So you have to be able to reasonably estimate how much cash the business will generate over its lifetime and then discount that back to today's dollars.
That's the math, yeah.
But the reality is, nobody has a crystal ball. You can't accurately project the cash flows of some software startup or a biotech company 10 years into the future. The variables change way too fast.
Which is exactly why Buffett and Munger simply walk away from those businesses. In that same 1994 meeting, Buffett explicitly states that there are all kinds of companies where he and Charlie don't have the faintest idea what the future stream of cash will look like.
Right.
And their solution to that risk isn't to build a more complex spreadsheet. Their solution is to just put it in the too hard pile.
They demand predictability.
Absolutely. They looked for companies like Gillette. Before people go to sleep, Hair grows on their faces. When they wake up, they use a razor.
Right.
Buffett could comfortably project the cash flows of Gillette because the consumer behavior was practically immutable.
This demand for absolute predictability brings us to a massive point of friction with traditional financial advice. Because modern finance theory preaches diversification. Like, if you go to a financial advisor, they will put you in a mutual fund with 500 different stocks.
Oh yeah, totally standard.
The logic is that if one goes bankrupt, it doesn't sink your whole portfolio. But in the 1996 Berkshire meeting, Buffett bluntly states that diversification is a protection against ignorance.
He argues that if you are a know-nothing investor, which, by the way, is perfectly fine for the vast majority of people, you should absolutely buy a broad index fund and dollar cost average over time.
Yeah, nothing wrong with that.
But if you are a professional capital allocator, if your full-time job is to analyze businesses, owning 50 or 100 stocks is an admission that you don't actually know what you're doing.
But isn't putting a massive percentage of your net worth into 2 or 3 companies incredibly dangerous? I mean, what if the management commits fraud? What if a new technology disrupts their moat? Think about playing poker, right? If you don't know exactly what the other players are holding, going all in on a single hand is suicidal. You play tight, you spread your bets.
That poker analogy is exactly how Munger views the market, but he comes at it from the perspective of a player who only bets when they can effectively see the opponent's cards. Wow, okay.
For Buffett and Munger, knowing 3 businesses intimately operating strictly within what they call their circle of competence is vastly less risky than owning 50 businesses that you only understand on a superficial level.
That makes a lot of sense.
In one of the Wesco letters, Munger points out that the idea that you shouldn't put a large percentage of your net worth into a business you understand perfectly simply because some academic says you need 2% in international equities is institutionalized lunacy.
Lunacy?
Yeah. When they find a business with a wide economic moat, excellent management, and a price that offers a massive margin of safety, they don't buy a tiny position, they back up the truck.
Right. Extreme concentration is only risky if you're operating outside your circle of competence.
Precisely.
And staying inside that circle requires an almost unnatural level of psychological discipline. This is where Charlie Munger's mental models become so critical. Because he didn't just have rules for buying stocks, he had rules for how his own brain was allowed to process information. Munger is arguably the most disciplined thinker in modern financial history, and his primary weapon against risk is a mental model called inversion.
I love this one.
It's brilliant. In the 1995 Berkshire shareholder letter, Buffett quotes Munger's favorite, slightly morbid operating principle: "All I want to know is where I'm going to die, so I'll never go there."
It's a funny line, but it's actually a really profound operating system for a massive conglomerate. But how does a corporate board actually implement knowing where you're going to die? Like, what does that look like?
Mechanically, it means you don't start by trying to figure out how to maximize your returns. You start by identifying every single theoretical path to ruin, and then you systematically eradicate those paths.
Oh, so you work backwards.
Yeah. In insurance or in investing, they constantly focus on the worst-case scenario. If they determine that a specific investment structure could theoretically bankrupt Berkshire Hathaway, even if the mathematical probability of that happening is less than 1%, they will not do the deal.
They refuse to plant the seeds of their own destruction, regardless of the potential upside.
Exactly.
So the goal isn't to be a visionary genius. The goal is to just systematically avoid being an idiot.
Pretty much. Munger explicitly stated that Berkshire is an old-fashioned place, and they exert massive discipline to stay that way. By old-fashioned, he means relying on eternal verities, basic mathematics, and a healthy dose of basic fear.
Basic fear. Right.
They observed that a lot of highly intelligent people fail in finance not because they aren't smart enough, but because they do something structurally stupid. They take on too much debt, or they bet the company on an unproven technology.
And this framework of avoiding structural stupidity completely dictates how they handle macroeconomic uncertainty. The financial media is just obsessed with predicting the macro environment. What is the Federal Reserve going to do with interest rates next month?
Oh, constantly.
What's the GDP growth rate for the 3rd quarter? Is inflation peaking? People build entire risk models based on those predictions.
During the 1997 annual meeting, the audience was peppered with macro questions. People wanted to know about inflation and market valuations. Munger confidently warned that real inflation-adjusted returns from investing in the stock market would likely be lower in the long-term future than they had been in the previous 15 years.
Because they understood the market was ebullient at the time.
Right. But here is the critical distinction. They don't respond to that macro uncertainty by trying to predict the exact timing of a crash and moving their portfolio to cash.
Because timing the market is just another form of speculation.
Exactly. You prepare for macro shocks by building a portfolio that can survive them without needing to predict them.
So you buy businesses that have pricing power. If inflation hits 10%, they can just raise the price of their product without losing volume.
Yeah. And you avoid companies with massive debt loads. So if interest rates spike to 15%, your companies aren't crushed by debt service costs. You neutralize macro risk at the micro level of the business itself.
Man, that's powerful. Let's talk about the psychological mechanics of taking a loss, because there's a fascinating exchange in the 1995 meeting where Buffett says, you don't have to make it back the way you lost it.
That's a huge psychological hurdle.
Yeah. And for context, in 1989, Berkshire invested $358 million in U.S. Air preferred stock. The airline industry was deregulating, brutal price wars broke out, the unit economics just collapsed, and by 1995, Buffett had to heavily write down the value of that investment.
It was a very public, very painful mistake. But Munger's expansion on Buffett's point reveals the deep psychological trap most investors fall into.
Right.
Munger explains that feeling the biological need to make your money back on the exact same stock where you lost it is precisely why gamblers go broke at the casino.
Human ego demands that we prove we weren't wrong.
Yes. We want to sit at the very same table or buy more of the very same plummeting tech stock to average down and eventually break even. Munger says this is a deeply ingrained flaw in human nature, and you have to use sheer brute force willpower to override it.
I understand the theory, but overriding human biology is incredibly difficult. Like, when your net worth is dropping by thousands of dollars a day, the panic is visceral. How do they actually execute that emotional detachment?
By actively fighting their own cognitive biases. Munger brought up Charles Darwin in the 1998 meeting to illustrate how to do this mechanically. He noted that Darwin understood the human mind is conditioned to reject contradictory evidence.
Because our brains will literally filter out new facts to protect our deeply held convictions.
Right. To combat this, whenever Darwin found any data that contradicted his previous theories, he forced himself to write it down almost immediately. He knew if he didn't write it down, his mind would conveniently forget it within an hour.
So if you buy a stock because you believe a new product launch is going to double their revenue, and then the earnings report comes out and the product launch is a total failure, your brain will automatically try to find excuses.
Oh, instantly.
You'll say, oh, it's just a supply chain issue. It'll bounce back next quarter.
Yes. To survive, you have to forcefully confront the facts that destroy your thesis. You have to write down why you are wrong. As Buffett joked in that same meeting, you might have all these deep emotional feelings about a specific stock.
You remember exactly what you paid for it on a Tuesday 3 years ago?
Exactly. But the stock market doesn't know you own the stock. The stock doesn't care what you paid for it. The underlying business economics are completely detached from your personal emotional journey.
It's one thing when our psychological biases cause us to hold on to a losing stock too long. That just results in a bad return. But when you combine those psychological blind spots with aggressive financial tools, you don't just get a loss, you get a systemic explosion.
That's where it gets truly dangerous.
Right. Which leads us to the ultimate destroyers of capital across all these decades of letters: leverage and bad incentives.
Leveraged borrowed money is undeniably the most consistent warning siren in the history of Berkshire Hathaway. In the 1998 meeting, the conversation naturally turned to the spectacular collapse of long-term capital management, or LTCM.
Oh, LTCM, what a story.
Yeah, this was a hedge fund run by the absolute titans of Wall Street. They had Nobel laureates on staff. These were the smartest quantitative minds on the planet, using incredibly complex arbitrage models, and they nearly took down the entire global financial system.
Let's look at the mechanics of what LTCM was actually doing, because it proves Buffett's point perfectly. They were finding tiny price discrepancies between different types of bonds. The spread was microscopic, with literally pennies.
Tiny, tiny margins.
Right, so to make a massive return, they used insane amounts of borrowed money. They were leveraged something like 30 to 1. They were basically picking up pennies in front of a steamroller.
And when the Russian government unexpectedly defaulted on its debt in August 1998, the bond markets just went haywire. The spreads didn't converge the way LTCM's historical models predicted. They widened dramatically.
And because LTCM was leveraged 30-to-1, a tiny move against them wiped out their entire equity base.
Completely. Buffett pointed out exactly why this happened. He said that when truly bright, experienced people go broke, it is almost always because of borrowed money.
He noted that if Berkshire had used significant leverage over its history, their returns would have been much higher, but they also would face moments of severe existential threat.
Buffett was unequivocal on this. He stated that adding leverage to squeeze out a few extra percentage points of return in a given year is never, ever worth risking total ruin.
Not even a little bit.
No. In the 1994 meeting, they were discussing someone who had gone bankrupt, and Munger delivered one of his most famous, visceral analogies. He simply asked, how can you fall off a pancake?
I think about that pancake analogy all the time. If you have zero debt, your financial foundation is completely flat.
Yeah.
You are laying flat on the ground. You literally cannot fall off.
Right.
But the minute you start taking on debt, you're building a vertical tower. And the higher the tower gets, the more catastrophic the fall is going to be when a macroeconomic wind blows through.
And the reason so many corporate executives keep building those dangerous towers comes down to incentive risk. Bad compensation structures create systemic peril. In the 1999 meeting, Munger compared modern corporate compensation plans to putting a rat colony in the granary.
Wow.
Yeah. When management is compensated based on short-term stock performance or hitting quarterly earnings targets, they are deeply incentivized to use leverage to artificially boost those numbers.
Right. They take on massive hidden risks to hit the target, get their multi-million-dollar bonus, and just walk away before the tower collapses. But if the history books are littered with the corpses of over-leveraged companies, why do the supposedly brilliant people running these Wall Street firms keep doing it? You have to wonder, is it just pure greed, or is there a structural flaw in the environment?
It is absolutely a structural flaw driven by asymmetric risk. Buffett pointed out that explosive financial instruments attract people who have very little to lose personally but can gain enormous payouts if the bet works.
Heads I win, tails you lose.
Exactly. Wall Street is a Darwinian environment that heavily selects for formidable sales skills and high energy, but those traits are completely decoupled from sound risk management.
Right.
So the trader structures a highly leveraged bet. If it works, he gets a $10 million bonus. If the bicycle hits a pebble and blows up, the trader loses his job, but he keeps his past bonuses. It's the shareholders who suffer the permanent loss of capital.
If leverage is the rocket engine that blows up the bicycle, then derivatives are the nuclear payload. We have to dive into the specific Berkshire examples here, because Buffett's 2002 shareholder letter contains one of the most famous warnings in financial history.
Oh, the financial weapons of mass destruction line.
Yes. This was shortly after the Enron collapse, and he explicitly called derivatives financial weapons of mass destruction.
That phrase is quoted constantly, but the mechanical reality of why he called them that is rarely understood. In that 2002 letter, Buffett warned that derivatives carry dangers that are latent but potentially lethal to the entire economy. He laid out a specific mechanical trap called the pile-on effect.
Let's walk through the exact mechanics of a margin call spiral, because it is terrifying when you realize how fragile the system is. Imagine a massive, seemingly stable corporation, let's say an insurance giant or an energy trading firm, that is entered into tens of thousands of derivative contracts.
Right.
These contracts are essentially massive bets on future events, like where interest rates will be in 5 years, or the creditworthiness of other companies.
Crucially, these contracts are often written with collateral triggers tied to the company's credit rating. So imagine that company suffers a general credit downgrade by Moody's or Standard & Poor's.
The downgrade might be for a completely unrelated reason, maybe a bad quarter in a different division.
Yeah, exactly. But the moment that downgrade hits, the trap door opens. The derivative contracts instantly require the company to post massive amounts of cash collateral to their trading counterparties.
So right when the company is struggling operationally and desperately needs liquidity, billions of dollars in cash are contractually sucked out of their accounts to cover these derivative margin calls.
Exactly. This sudden, unexpected demand for billions in cash throws the company into a severe liquidity crisis. The rating agencies see the liquidity crisis, so they downgrade the company again.
Oh man, a death spiral.
Yeah. That second downgrade triggers more margin calls, which drains the last of their cash, leading to a total corporate meltdown. It's an unstoppable death spiral. It's exactly what happened to AIG years later in 2008, and Buffett predicted the exact mechanics of it in 2002.
And Charlie Munger points out in the transcripts that the accounting rules surrounding these derivatives are an absolute sham. He stated that the accounting profession essentially sold out to the Wall Street firms trading these instruments.
Munger despised the practice of mark-to-model accounting. In a standard business, you sell a product, collect the cash, and report the profit. But with complex, long-term derivative contracts, there is no active market price.
So they just make it up.
Pretty much. The traders use their own mathematical models to estimate how much profit the contract will make over the next 20 years. They then report all of that theoretical future profit on the income statement today.
So the trader gets a massive bonus today based on imaginary money, the CEO reports record earnings, and only years later, when the model turns out to be flawed, do the shareholders realize the profits were an illusion.
Munger called it an irresponsible clearing system combined with irresponsible accounting.
Which is exactly why Buffett stated that he personally initiates and monitors every single derivative contract on Berkshire's books. He absolutely refuses to delegate risk control to a committee. He has to understand every single worst-case scenario.
He demands total visibility.
But this brings us to a massive paradox in their philosophy. We've just spent, a half hour establishing how risk-averse they are.
Yeah.
They hate debt. They hate opaque accounting. They want to stand on a flat pancake. And yet, Berkshire Hathaway intentionally takes on the most massive, terrifying risks on the planet.
Super catastrophe reinsurance.
Yes. This is perhaps the most fascinating aspect of their entire operation. Berkshire acts as the ultimate financial backstop for the worst natural disasters imaginable. We're talking about super catastrophes events so large they would bankrupt normal insurance companies.
In the 1994 Wesco letter and the 1994 Berkshire shareholder letter, they explain the mechanics of this. The Northridge earthquake had just hit California in January 1994, causing billions in damage. Most insurers were terrified and retreating.
But Buffett and Munger stepped up.
They did. They wrote policies covering California earthquakes, Florida hurricanes, and even the launch of experimental commercial satellites. Buffett casually mentions they are willing to lose $2 billion to $2.5 billion in a single event.
They talk about writing coverage for a potential $50 billion windstorm hitting Long Island. How on earth is stepping in front of a $50 billion hurricane considered conservative?
It sounds like a total contradiction, I know. But it perfectly illustrates the difference between emotional risk and mathematical risk. The secret is their Fort Knox balance sheet.
Okay, break that down.
Standard insurance companies are fragile. When they write a massive policy, they immediately lay off some of that risk by buying retrocession insurance from other companies. It's a giant web of interconnected promises.
Right. And if a $50 billion earthquake hits, that entire web collapses. The reinsurers default on each other and everybody goes bankrupt.
Exactly. But Berkshire doesn't use retrocession. They don't rely on anybody else to help pay the claims.
Precisely. Berkshire operates as a standalone, impenetrable fortress. They have enormous capital reserves, massive cash streams coming in from their non-insurance businesses like See's Candies and their utilities, and zero debt.
Because they're standing on that financial pancake, a catastrophic loss of $2 billion would hurt their earnings for a quarter, but it wouldn't threaten the survival of the enterprise. It dents the armor, it doesn't pierce the heart.
They constantly monitor their aggregate exposure. In his 1995 letter, Buffett states that they rigorously modeled the ultimate worst-case scenario. They imagine a massive Long Island hurricane, a catastrophic California earthquake, and a third supercat event all happening in the exact same year, combined with a severe stock market crash.
And only if they can mathematically survive that apocalyptic scenario without blinking do they underwrite the policies.
And they only write these policies when the math is wildly skewed in their favor. Buffett compares it to flipping a coin. If you know for a fact that the coin is honest and someone offers you 7 to 5 odds on the flip, you take that bet every single time.
Yeah, it doesn't matter if you lose the first 3 flips. Over the law of large numbers, you will make a fortune. After the Northridge earthquake, the premiums for supercat insurance skyrocketed. Berkshire stepped in and collected massive premiums when everyone else was paralyzed by fear.
And this leads to an incredible insight from the 1996 letter. Buffett explicitly states that he prefers a lumpy 15% over time than a smooth 12%.
That sentence is the absolute essence of their structural advantage over Wall Street. A standard public CEO is terrified of volatility. They are obsessed with smoothing their earnings to please Wall Street analysts.
Right.
They will literally turn down a highly profitable, mathematically sound investment if it means their quarterly earnings chart might have a temporary dip. They sacrifice long-term wealth to maintain the illusion of a smooth upward line.
Because if the line dips, the stock drops, and your stock options lose value. It goes back to the rat colony in the granary.
Exactly. Buffett and Munger don't care about smooth lines. They are perfectly willing to report a terrible quarter, or even a terrible year, where they lose billions on an earthquake.
Because they know that by collecting those massive, mathematically advantageous premiums over a decade, their overall return will crush the competition.
They are mathematically conservative, but operationally incredibly bold. They let everyone else fight over the safe, smooth 12%, while they quietly absorb the volatility to capture the lumpy 15%.
So analyzing how Berkshire Hathaway operates on a multi-billion-dollar scale is fascinating history, but we need to translate this. How do you actually apply these billionaire strategies to a standard retirement portfolio or a small business? What are the mechanical, practical lessons here?
The first, most critical lesson is about liquidity and preparation. Drawing directly from Buffett's letters, there is this concept of financing in anticipation of need. The reality of financial markets is that the opportunities to borrow cheap money and the opportunities to buy incredibly cheap assets almost never happen at the exact same time.
Because human emotion drives the cycle. When money is cheap and credit is flowing, everybody is euphoric, so asset prices are bid up to the stratosphere. You can't find bargains. But when a panic hits and assets are finally cheap, the credit markets freeze. You can't get a loan to buy the cheap assets because the banks are terrified.
Which means you have to act asynchronously. Buffett advises taking action on the liability side of your balance sheet, completely independent of the asset side.
Okay, so you secure your financing, you lock in long-term fixed-rate debt, or you aggressively hoard cash when the markets are calm and money is practically free.
You do this knowing you might sit on that cash for years, earning almost nothing. But you do it so that when the inevitable panic hits and credit dries up, you are the only one in the room with liquidity. His operating principle is simple. If you want to shoot rare, fast-moving elephants, you should always carry a loaded gun.
A loaded elephant gun. But holding that gun requires an agonizing amount of patience. And there's a vital nuance about their cash position that is constantly misunderstood by the financial media. In the 1994 meeting, an audience member asked if Berkshire hoards cash because Buffett is secretly predicting a massive market crash. He wanted to know if the cash was a macro timing signal.
Right. People always want it to be a signal.
But Buffett was very clear. Cash at Berkshire is a residual.
That is such an important distinction. They do not want to hold cash. Cash is a terrible long-term asset. Its purchasing power is constantly degraded by inflation. They would vastly prefer to have zero cash and have 100% of their capital deployed in high-yielding, wonderful businesses. When you see Berkshire sitting on billions of dollars in cash, it is not because they are trying to time the market.
It's simply the residual mathematical effect of them looking at thousands of potential investments and deciding that none of them clear their hurdle rate.
Exactly. They are refusing to swing at bad pitches, and the cash just piles up by default.
And when the bad times do roll around, they don't panic. In fact, they welcome it. During the 2001 meeting, amidst the fallout of the dot-com bust, Buffett casually mentioned that Berkshire would actually benefit over a 20-year period from having some terrible prolonged bear markets.
Think about the mechanics of why that is true. If you are a net buyer of stocks over the next 20 years, which anyone saving for retirement is a terrible market, is the greatest gift you can receive.
Absolutely. A bear market allows you to acquire pieces of great businesses at a lower cost basis, which supercharges your long-term compounding.
Munger explicitly stated that they will never sell everything and go to cash waiting for a crash. They stay invested in great businesses, but because they have no leverage and they maintain that residual cash pile, they are structurally positioned so that market turmoil serves them rather than destroys them.
So you have your loaded elephant gun, you wait patiently through the ebullient markets, you embrace the bear market, you buy a great business at a price that offers a massive margin of safety, and then what? What is the final step in the process?
Final step is mastering the power of inactivity.
In the 1996 shareholder letter, Buffett tells a great story about Robert Woodruff, the legendary business genius who built Coca-Cola into a global empire. Someone once asked Woodruff when might be a strategically good time to sell Coca-Cola stock, and Woodruff simply replied, I don't know. I've never sold any.
Buffett uses that story to highlight the ultimate folly of active management. Trying to dance in and out of the companies you love on a short-term basis is a terrible idea.
Just a total waste of energy.
Yeah. If you have done the rigorous work to find a truly great company with a durable competitive advantage, you sit on it. You don't sell it just because the macro environment looks a little shaky or because you think the stock is temporarily overvalued and you hope to buy it back 10% cheaper next month.
Because if you try to trade around your best ideas, you will inevitably outsmart yourself, you will trigger massive tax bills, and you will miss out on the decade-long compounding that actually creates generational wealth.
Right. But doing absolutely nothing is arguably the hardest psychological challenge for an investor.
Oh, without a doubt.
Yeah.
There's a great analogy about a soccer goalie facing a penalty kick. Statistically, the absolute best move for a goalie to make is to stand dead center, because a huge percentage of penalty kicks go right down the middle.
Yeah, but they never do that.
No, because human psychology forces the goalie to dive wildly to the left or to the right. Why? Because if they dive and the ball goes in the other corner, at least they feel like they did something. They tried.
They look busy.
Exactly. But if they just stand completely still in the center and the ball goes past them, they look foolish to the crowd.
That bias toward action is deeply hardwired into us. We want to trade, we want to read the latest earnings report and tweak our portfolio weightings. We want to feel like we are actively managing our destiny.
But true investing, the framework built by Buffett and Munger, requires extreme, almost agonizing patience, punctuated by very brief moments of aggressive action when the odds are overwhelmingly mathematically in your favor.
That's the whole game.
So let's bring this massive deep dive to a close. What is the ultimate takeaway from combing through 30 years of transcripts, letters, and history? Risk is not a squiggly line on a chart. Risk is not price volatility. Risk is permanent capital loss.
Yes.
And that permanent loss is driven by using leverage to build a fragile tower instead of standing on a pancake. It's driven by Wall Street's toxic compensation incentives. It's driven by our biological inability to accept contradictory evidence and our ego-driven urge to win back our money at the exact same table where we lost it. And it's driven by straying outside of our circle of competence.
True safety doesn't come from modern portfolio theory or beta or complex derivatives that hide reality behind mark-to-model accounting. True safety comes from demanding an immovable margin of safety.
An immovable margin of safety.
It comes from a total, absolute lack of debt. And it comes from the emotional discipline to ignore the crowd, to welcome Mr. Market's manic depression as a tool rather than a threat, and to view your stocks not as flashing ticker symbols, but as fractional ownership in real cash-producing businesses.
As we wrap up this analysis, we want to leave you with one final thought to mull over, a culmination of everything we've dissected today.
Consider this reality. In a modern financial ecosystem built entirely on speed, massive leverage, algorithmic high-frequency trading, and continuous frenetic action, the single greatest competitive advantage you might have as an individual investor is simply your willingness to sit completely still, to look incredibly boring, and to wait patiently, perhaps for years, for everyone else in the market to make a fatal mistake.
Zillow might tell you your house is worth 20% less tomorrow, but you know the roof doesn't leak. You know you're safe. Thank you for joining us on this deep dive. We'll see you next time.